In a word, a blockchain is a database. If you know what we're talking about when we talk about Excel spreadsheets, you're more than halfway to understanding blockchains. But let's not make the mistake of contextualizing them as something trivial. The reality is quite the opposite.
Blockchains have a number of technological tricks up their sleeves and hold implications so powerful that they make world governments flinch. These databases may be used for everything from tabulating a vote to tracking the price of crude oil. But the most popular blockchain use case by far is as a decentralized ledger for cryptocurrency transactions.
Blockchain was invented by an unknown individual or group of people working under the pseudonym Satoshi Nakamoto. A technical white paper published in 2008 breaks down the what's and why's of blockchain as the software centerpiece that supports Bitcoin, the world's first blockchain-based cryptocurrency.
Only one blockchain contains all the world's Bitcoin transactions, but every blockchain has the same special set of skills. Specifically, they are formed on the basis of a decentralized network. It takes a number of independent individuals to work together to perpetuate the network, and data stored in a blockchain is unchangeable.
This means you not only have access to the present value of a cell in this database, but you have access to every instance of that cell's previous data. You may also hear this blockchain characteristic called immutability or uncensorability, but it fundamentally means blockchain transactions are impossible to forge.
This is all driven by cryptography. To get an entry-level understanding of how cryptography and decentralization make blockchains uncensorable, let's check out this example. A new transaction enters the blockchain and generates a hash, a long string of numbers and letters. The hash that's generated depends not only on this transaction's characteristics, but on the previous transaction's hash as well. Even the smallest of changes in a transaction generates an entirely new hash. Nodes, computers responsible for checking the validity of each transaction, inspect hashes to make sure nothing has been forged. If most nodes approve a transaction, then that transaction gets written into a block. In the spreadsheet's analogy to blockchain, this is the moment where data actually enters a cell. Each block then refers to a previous block filled with congruent information, and this chain of blocks forms the so-called blockchain.
Important things to keep in mind about blockchains. A blockchain is spread over a network of computers or nodes. Each computer contains a complete copy of the blockchain. A blockchain regularly updates all nodes in its network at a regular interval. For example, the Bitcoin blockchain updates every 10 minutes. As soon as a new block is entered, it becomes permanent and cannot be changed. Only new entries can be added to it. The updates occur across all the computers in the network at the same time, making it tough to hack a blockchain. What is Bitcoin? Bitcoin launched in January 2009 as the first decentralized cryptocurrency. Without Satoshi Nakamoto to unveil Bitcoin, the cryptocurrency market that we know today simply would not exist. Bitcoin was conceived as a type of electronic cash that allows for sending payments from one party to another without any financial institutions or central authorities involved. It has become immensely successful in its short history, with a market cap in excess of $1 trillion. Bitcoin's price is often considered the indicator of health for the overall industry. What is Ethereum? Ethereum is the most popular alternative cryptocurrency to Bitcoin, but it's also a platform for building and launching uncensorable software applications called dApps. Ethereum has assumed a massive role within the market despite having a market cap that's just a fraction of Bitcoin's. Ethereum launched in July 2015 and has since become the world's most established, open-ended decentralized software platform. Ethereum's decentralized software applications are made possible by smart contracts, which are self-executing contracts that represent the terms of an agreement between a buyer and a seller as computer code. Smart contracts running on Ethereum's blockchain are like an autonomous computer that automatically runs a program when specific conditions are met, perhaps buying a set amount of cryptocurrency when that token hits a certain price. What are altcoins? The term altcoin refers to any cryptocurrency that isn't called Bitcoin or Ethereum. Altcoins generally brand themselves as some improved alternative to Bitcoin, and they vary widely in terms of features and functions. There are over 6,000 altcoins in existence, and they have names like Litecoin, Algorand, Dogecoin, and beyond. What are stablecoins? Stablecoins are the price-steady antidote to volatile cryptocurrencies like Bitcoin. Stablecoins use one of a variety of methods to represent stable value on the blockchain. These are commonly pegged to major fiat assets like the US dollar. Bitcoin may be up today and down tomorrow, but stablecoins exist to capture and preserve value more intuitively. Crypto is the future. More people than ever are finding fault with the world's centralized fiat financial system. It's perhaps best exemplified in Venezuela, due to the ongoing political and socio-economic tensions that began in 2016. The country saw 1,370,001% inflation in its national currency in 2019. That kind of number spells out hyperinflation, in which economic circumstances send a currency's value to nearly zero. Even world superpowers like America stand to benefit here. The financial news cycle nearly flipped upside down in the wake of the GameStop short squeeze, and when retail trading platform Robinhood halted trading on the stock, it was gas on a figurative fire. Despite allying itself and affiliating itself with underdog traders, Robinhood is now the go-to example of how people have way less than 100% control over their money. And news of the US money printer is hard to keep quiet. With some Americans receiving 2 rounds of stimulus checks, the masses are more readily connecting the dots that fiat money is less than a fair proposition. Cryptocurrency technology puts a stop to all of this at once. Blockchains are designed to securely transact value between 2 parties, whether they trust each other or not. The question that more people are waking up to, however, is about whether they trust the people who print and back their fiat money. The global financial system. A financial system is a set of institutions that allow for the exchange of funds or currency. These institutions may include banks, insurance companies, and stock exchanges. A financial system also consists of the rules and practices that borrowers and lenders use to determine economic deals, who gets to finance specific projects, and which projects get funded. Financial systems exist in varying scales. The smallest may be that of a particular company. The largest is the interconnected global financial system, which covers all financial institutions, borrowers, and lenders in the global economy. It is the global framework of legal agreements, institutions, and formal and informal economic decision-makers that dictate the international flows of financial capital. The institutions involved in the decision-making end of this system include central banks, major private international banks, government treasuries, monetary authorities, the World Bank, and the International Monetary Fund. The global financial system comes with a lot of jargon and technical speak, but it all boils down to one straightforward concept: ensuring the stability of the global economy. That is quite a lot of pressure for the institutions involved, as they are the sole decision makers and are responsible for the global economy. All it takes is one divergent nation or crisis to shatter this delicate stability. The evolution of money. Money has been a part of human history for at least 3,000 years. Money's worth comes from it being a medium of exchange, measurement, and store of wealth. If society did not universally agree to this accepted value and form of payment, money would be worthless. That's why money has evolved so drastically over the years. Coins made from precious metals appeared first, replacing the previous barter system for trading goods and services. Paper currency replaced coins over time as it was more convenient. The first instances of paper currency issued by a government occurred in early North America, as shipments between Europe and the colonies took so long that the colonists would often run out of coins. Instead of going back to the barter system, they traded IOUs as a form of currency. In the beginnings of paper currency, it could be traded at any time for precious metal coins at a bank. This standard eventually came to an end in the 20th century and was replaced by fiat money. Fiat is currency used by the government's order and must be accepted as payment. Fiat money is backed by nothing other than the word and power of the issuing government. Money has continued to evolve in the fiat stage. Most payments are made now without exchanging physical currency. We use plastic cards that point to our money instead, or we use PayPal and Venmo to transact virtually.
Cryptocurrencies are the future as they provide a solution to a rising crisis in the global economy. Cryptocurrencies improve centralized financial systems with their decentralized nature and finite supply. However, because cryptocurrencies are a threat to institutions, it may take a while for their adoption. Thank you for watching this section of the Token Metrics detailed course on cryptocurrencies and blockchain. See you in another section.